Live from New York, I'm Romain Bostic.
And from London, I'm Guy Johnson. This is Bloomberg Markets. Romain, let's go to Chicago now. Futures in focus. Bill Baruch, Blue Line Futures, joins us now from the CME. Bill, what did people make of the Fed up there? The chair didn't seem to answer many of the questions. We seem to have a difficult sort of journey here trying to understand exactly when the future rate cuts come in. How data dependent is the Fed? What kind of questions are you asking?
I think ultimately that press conference went as good as it could. He didn't say a lot, and that's what the market needed. Saying too much can really bring a lot of volatility. And yeah, the S&P and the markets traded lower early, right after that news. They didn't like the fact that the members don't see additional cuts. But here's the thing. I've been saying we're going to see this transition of where the market goes from Fed easing dependent to Fed data dependent. Manufacturing has been the real one that we're missing right now. Philly Fed this today. I put a note out for my clients. Look for Philly Fed. If it beats today, the stock market's going to run higher. We're right at near record highs, and I think right now we could make that transition of becoming more data dependent, and that's going to support the market making new record highs.
Okay, so that's equities taken care of. Let's talk a bit about what's happening in the oil market. Look, we've had a really bumpy week. Nobody's quite sure how much oil is going to be coming out of Saudi. Where do you think we are? Where does the market think we are in terms of Saudi delivering?
The market believed it earlier in the week. We saw crude oil sell off below $58. That was a big support level we broke through. But now with news that Saudi Arabia is buying millions of barrels of oil from Iraq to help meet demand that they have for their customers, that started to pick things up. You still got ever-present tensions with Iran. Iran calling for, if they get striked, there's going to be an all-out war. We could wake up any day and there is some sort of heightened geopolitical tension, some sort of potential war breaking out. That's the risk if you're fading this market. But I wouldn't be fading it here. Early in the week, I would say you could look to fade in the 63 range. It could be going back up there. You could see additional premium coming in ahead of the weekend. So I'd be cautious. It's okay to be wrong. Just don't stay wrong. Have your points if you're trading this thing.
Absolutely. Okay, so how are people protecting themselves? You got kind of a collar on here. If Saudi gets it together, the price comes back down again. If Saudi doesn't get it together, the price shoots higher. Kind of how do you position yourself in that V or either side of it?
I'm looking at the longer-term trend. Over the last 20 years, we've seen a peak to trough, peaking in September through October, a sell-off of about 8% in crude oil. I think this is a seasonally weaker time of year. I'm looking for those rallies to fade. If we get upwards in that near $62, $63 area, that's where I would look to be fading it. And yeah, I would protect myself with some calls because I don't want to wake up one night and this thing being $5, $6, $10 higher because war is breaking out. I don't think crude oil stays up here, though. I mean, the U.S. production is right on track. And I think Saudi Arabia is going to find themselves on track here soon enough.
Thanks, Bill. Great to see you. Bill Baruch joining us from Blue Line Futures out of Chicago. Romain.